Preparing for a due diligence analyst interview, you've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a due diligence analyst do in a transaction? A due diligence analyst helps a buyer, lender, or investor understand what they are really buying before signing or funding a deal. I review financials, operating metrics, contracts, tax items, customer data, and management claims, then identify risks, deal adjustments, and value drivers. The job is not just checking numbers, it is translating evidence into implications for valuation, purchase price, warranties, covenants, and integration planning after close. While answering, focus on the analyst's role in validating information, identifying risks, supporting valuation, and translating financial, operational, legal, and commercial findings into transaction decisions. Question 2. Walk me through the key areas you would review in financial due diligence. I start with the income statement, balance sheet, cash flows, and trial balance to reconcile the reported numbers. Then I assess quality of earnings, normalize EBITDA, review revenue and margin trends, and identify non-recurring items. On the balance sheet, I focus on working capital, debt-like liabilities, accruals, deferred revenue, CapEx, and cash restrictions. The objective is to show sustainable earnings and what adjustments should affect price, structure, or negotiation. Make sure to cover quality of earnings, working capital, debt-like items, revenue trends, margin analysis, cash flow conversion, accounting policies, one-off items, customer concentration, and supporting documentation. Question 3. How would you assess the quality of earnings of a target company? Quality of earnings is about determining whether reported profit reflects sustainable economic performance. I would bridge reported EBITDA to adjusted EBITDA by testing one-time gains, unusual expenses, related party transactions, owner compensation, discontinued customers, accounting policy changes, and revenue cutoff. I would also compare EBITDA to operating cash flow to check cash conversion. If earnings rely on aggressive accruals or temporary demand, I would flag that as valuation risk. In your answer, talk about normalized EBITDA, recurring versus non-recurring items, revenue recognition, expense classification, owner add-backs, accounting estimates, and whether earnings convert into cash. Question 4. What are examples of EBITDA adjustments you might propose during due diligence? Common EBITDA adjustments include removing one-time restructuring costs, transaction expenses, owner personal costs, unusual litigation, or COVID-type disruptions, if they are truly non-recurring. I would also reverse non-recurring income, normalize related party pricing, adjust for discontinued customers, and correct accounting errors. I am careful with add-backs. Every adjustment needs evidence, timing, and a clear link to future performance. Overstated adjusted EBITDA can directly inflate purchase price multiples. Be sure to mention both positive and negative adjustments, including one-off costs, non-recurring income, owner expenses, run rate savings, litigation, related party pricing, discontinued products, and accounting corrections. Question 5. How do you analyze net working capital in a deal? Working capital analysis protects the buyer from inheriting an underfunded business. I calculate normal net working capital, usually excluding cash, debt, tax, and non-operating items, then compare it to the closing balance. I look at seasonality, growth, AR aging, inventory obsolescence, supplier payment stretching, and deferred revenue. If the target delivers working capital below the agreed peg, the purchase price is typically reduced dollar for dollar to restore normal operating liquidity. While answering, focus on the working capital peg, seasonality, AR collectibility, inventory reserves, AP timing, deferred revenue, normalization period, and how working capital affects purchase price. Question 6. What are debt-like items, and why do they matter in due diligence? Debt-like items are liabilities that behave economically like debt, even if they are not labeled as bank borrowings. Examples include unpaid taxes, accrued bonuses, seller notes, finance leases, litigation settlements, customer advances, pension deficits, and overdue payables. They matter because deals are often priced on a cash-free, debt-free basis. Identifying debt-like items ensures the buyer does not pay equity value for obligations that should reduce proceeds to the seller. Make sure to explain enterprise value to equity value bridge, hidden liabilities, leases, unpaid taxes, accrued bonuses, litigation, customer advances, factoring, pension deficits, and purchase price adjustments. Question 7. How would you investigate a sudden spike in revenue before a sale process? I would first break revenue down by customer, product, month, price, and volume to see what drove the spike. Then I would test cutoff around period end, inspect contracts and invoices, review collections, and check for returns, discounts, bill and hold arrangements, or channel stuffing. I would ask management whether the increase came from recurring demand or one-time orders. If it is not repeatable, I would adjust run rate revenue and EBITDA. In your answer, talk about cutoff testing, customer-level analysis, pricing changes, channel stuffing, one-time orders, contract terms, returns, deferred revenue, and whether the spike is recurring. Question 8. What red flags would you look for in a data room? Red flags include missing support for key numbers, financial statements that do not reconcile to trial balances, unexplained EBITDA add-backs, weak revenue recognition evidence, or large manual journal entries near period end. I also watch for overdue receivables, inventory buildup, related party transactions, customer churn, covenant breaches, tax exposures, and inconsistent management explanations. A messy data room is not always fatal, but it often signals control weaknesses or hidden negotiation issues. Be sure to mention missing reconciliations, inconsistent financials, unexplained adjustments, unusual related party transactions, aging receivables, customer churn, management reluctance, weak controls, and contracts that contradict reported results. Question 9. How do you approach management interviews during due diligence? I treat management interviews as evidence gathering, not casual conversations. Before the call, I analyze the data room and prepare targeted questions on trends, anomalies, accounting policies, customer movements, and forecast assumptions. During the interview, I ask open-ended questions first, then follow up with specific data points. Afterward, I document responses and cross-check them against contracts, ledgers, invoices, and third-party evidence. The goal is to separate narrative from supportable fact. While answering, focus on preparation, using financial analysis to shape questions, testing assumptions, asking open-ended follow-ups, documenting answers, and reconciling management commentary to evidence. Question 10. How would you test customer concentration risk? I would rank customers by revenue and gross margin, then calculate the percentage represented by the top 5 or 10 customers. Next, I would review contract terms, renewal dates, pricing clauses, churn history, payment behavior, and whether relationships depend on specific employees. If one customer represents 35% of EBITDA and has no long-term contract, that is a serious risk. It may affect valuation, debt capacity, reps and warranties, or earn-out structure. Make sure to cover revenue by customer, margin contribution, contract duration, renewal terms, churn history, dependency risk, customer interviews, pipeline replacement, and impact on valuation or covenants. Question 11. How do you verify whether a target's forecast is reasonable? I would not accept the forecast as a standalone management presentation. I would compare it to historical growth, margin trends, backlog, signed contracts, pipeline conversion, customer retention, pricing assumptions, hiring plans, and capacity constraints. I would build a bridge from the last actual period to the forecast and challenge each driver. If projected EBITDA improves sharply without evidence in revenue, cost savings, or mix, I would recommend a downside case. In your answer, talk about historical performance, bridge from actuals to forecast, revenue pipeline, backlog, margins, headcount, CapEx, customer retention, management assumptions, and downside cases. Question 12. What is the difference between financial, commercial, legal, and tax due diligence? Financial due diligence focuses on earnings quality, working capital, debt-like items, and cash flow. Commercial due diligence tests the market, competition, customers, pricing power, and growth thesis. Legal due diligence reviews contracts, ownership, litigation, compliance, and change of control issues. Tax due diligence identifies exposures, structuring risks, and unpaid obligations. These work streams connect because a legal contract issue can affect revenue quality, tax exposure can become debt-like, and commercial weakness can reduce valuation. Be sure to distinguish the work streams clearly while showing how they connect. Financial performance, market attractiveness, contracts and liabilities, tax exposures, and combined impact on deal terms. Question 13. Tell me about a time you found an inconsistency in financial data. How would you handle it? I would handle it by staying factual and structured. Suppose reported revenue did not tie to the general ledger by $500,000. I would trace the variance through invoices, deferred revenue schedules, credit notes, and cutoff entries before raising conclusions. Then I would quantify whether EBITDA, working capital, or revenue trends are affected. I would communicate the issue clearly to the manager and request support from the target without implying misconduct prematurely. While answering, use a structured approach. Identify the inconsistency, reconcile source documents, quantify the impact, escalate appropriately, avoid accusations, and explain implications for the deal team. Question 14. How would you prioritize work when the deal timeline is very tight? On a tight timeline, I prioritize areas that can change price, structure, or the investment decision. That usually means EBITDA quality, working capital, debt-like items, revenue sustainability, customer concentration, and major liabilities. I would set materiality thresholds, maintain a live issues list, escalate blockers quickly, and avoid spending time on immaterial perfection. Speed matters, but conclusions still need evidence. I would communicate confidence levels clearly rather than overstate certainty. Make sure to mention materiality, transaction risk, critical path items, stakeholder communication, version control, data request prioritization, escalation, and balancing speed with evidence quality. Question 15. What would you include in a due diligence findings report for an investment committee? For an investment committee, I would keep the report decision-focused. I would include an executive summary, transaction background, quality of earnings bridge, key EBITDA adjustments, working capital analysis, debt-like items, cash flow trends, revenue quality, customer concentration, and major risks. I would clearly separate confirmed findings from open items and quantify financial impact wherever possible. The conclusion should explain what affects valuation, purchase agreement protections, financing assumptions, or post-close priorities. In your answer, talk about executive summary, key findings, adjusted EBITDA bridge, working capital peg, debt-like items, quality of revenue, risks, opportunities, data limitations, and recommended deal actions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.